Welcome to KSB's and ADB's webinar on capital markets. This is the 20th webinar hosted by KSB, and this time I'm delighted to have Asian National Bank supporting us for this particular webinar because effective communication, transparency, financial disclosure is a critical pillar which is required and is a necessity for building trust with investors, which I think is necessary for an efficient capital markets. KSB Group has since 1952 played a critical role in developing Pakistan's capital markets. They have brought in more than $10 billion of foreign investment into Pakistan since 1992. My name is Farid Khwaja. I'm the chairman of KSB. I'm based in London. And over the last 15 years, I've worked in various roles as an investor, as a fund manager, as a sales side analyst, and as an operator of a company listed on London Stock Exchange. As a fund manager, I invested in emerging markets, starting from Russia, going down to Eastern Europe, Middle East, South Asia, Africa, all the way down to South Africa. I thought investor relationship and effective communication with investors was a weakness of Pakistani companies, especially compared to our counterparts across the border in India, which I thought did a much better role in telling the story to investors. I think Pakistan has improved since then. Before we start, I must thank Pakistan Stock Exchange, CFA Society Pakistan, Capital Stake, DBTV for promoting this webinar. So it is being, besides the 55 odd people who are on this call, this webinar is being live streamed on PSX website and the other platforms which I mentioned. Before I go to Simon, I want to hop over to Sana to say a few words about ADB, and I have to thank her for the support she's providing us for this. So Sana, over to you.
Hi everyone, welcome to this webinar. Thank you for logging in. This is our first collaboration with KSB as part of our knowledge events in Pakistan. I'm Sana Masood. I am the financial sector person focal for ADB in Pakistan. Again, special thanks to KSB, PSX, IFM, CFA Society to help and organize and publicize this event. And of course, Simon for being our speaker today. Why we are doing this? Development of the financial sector and capital markets is a key priority for ADB in ADB's strategy to support sustainable economic development and create an enabling environment for private sector investment. ADB has been the lead partner, development partner in the capital markets area for Pakistan. We've supported the development of the financial markets through different initiatives over the past 2 decades, including the establishment of the Securities Exchange Commission of Pakistan. We're also currently working with the government on a capital markets development program, which will be a policy-based support for the government. And during our engagement with the government and the stakeholders, investor education has been frequently raised as an area which required investment, intervention, attention. So again, we're very, very happy to collaborate with KSB on a series of webinars that we'll bring to the stakeholders here. Basically with an idea to bring global ideas, thoughts and views to the stakeholders and players in Pakistan and give investors and companies an understanding of what can be done to improve further. So thank you again. Ali, handing it to you to introduce the topic today and our speaker, Simon. Thank you.
Thank you, Sana. IR, as I said earlier, is a very important role communicating your story. It's essential for building trust with investors. So I'm delighted to have Simon Chisholm join us from London. Simon is the CEO of Feros Advisors, which is a capital markets communication and IR firm. They provide IR advice to companies across Europe. Simon has a long history in capital markets. He was a fund manager at doing European small and mid-cap investments at Janus Henderson, which is the largest asset manager in the UK. And after that, he was the head of equities of Berenberg, where I had the privilege of working with him. So Simon, with that, it's over to you. Would love to hear your views and your insights on A, why is IR important? And B, how can companies who are listening to this improve their communication with their investors? So over to you, Simon.
Great, thanks, Ali. Firstly, and to keep it shorter, I'll just thank all the same people that Ali and Sana thanked at the beginning. So thank you, all of you, for having me. It's an honour and a privilege, I think, to do this. Not the first time for a while I put a proper shirt on, so thank you making me do that as well. So briefly, first, who am I and why should I be offering advice on such a subject? If I even rewind all the way back to when I was at university, which was now sadly a very, very long time ago, I did my dissertation there into the psychology of the investment decision. It wasn't something that I'd grown up as a small child wishing to do. It was what my tutor wanted me to do because he was doing a PhD and I wanted a good grade. So it seemed like a decent trade to me. And during that process, I then met and went and interviewed and worked with lots of different asset managers to try and figure out what it was and made them pull the trigger and how they thought about that process. And not less of the process you will hear spoken about with investors, and I'll come back to that. Also around the softer elements around the decision process as well. So post my university degree, I did the obligatory accountancy qualification. So I went through one of the big five factories, qualified there. It was fantastic training. It was amazing training, not a lifelong ambition, but a fantastic training. And then going back to the time when I met the fund managers, I just remember sitting down and being incredibly impressed with these individuals. I'm going to remind you that I was young, thinking these guys just know everything about everything. I want to know everything. And in essence, that comes back to why fund managers are fund managers. And it's because whether they know it or not, or acknowledge it or not, they have a deep love of learning. Because the best thing you do as a fund manager every day is you get to learn stuff about stuff you don't know about. So it's also important when we think about how we talk to them and when we talk to them in messages. I'll come on to many. I do have a presentation. I'm not going to share it on the screen. I will distribute it afterwards. I'll give it to Ali to share and distribute afterwards, largely because if there are working within the equities business for many, many years, realizing that people broadly within that industry have quite a short attention span. So if we put the bright, shiny presentation on the screen, they'll just play with it. So we'll leave it, we'll distribute it afterwards. Anyway, back to me. Fund managers, thought I want to be a fund manager, they're great. Qualified as an accountant, then was an asset manager for eight years. Realised I loved the bit of meeting companies, excited about the bit of buying and selling shares. The rest of it, not so much. I was approached by Berenberg at the turn of about 2001, when professionally I'd been losing other people's money for 3 years. I want to stress, been losing marginally less than my competitors. So, but nonetheless, it was a bit, wasn't exactly getting me out of bed in the morning. And was approached to set up an equities business for a small German bank that, unless you were based in Hamburg, you probably never heard of, called Berenberg. And I proudly was head of that business, the equities business unit, for 10, 11 years with a colleague. So I co-headed it. I don't want to take all the credit. And built the business from 2 or 3 of us in a Harry Potter-sized cupboard to 100, 150 people across many different geographies. Loved the early bit, less loved the management bit. I was lucky enough to recruit Ali at that time, so which was one of the highlights. Anyway, so moving on to Feros, what we do now, realising that as a result of regulation, which I won't go into, UK banks make less money. As a result of UK banks making less money, equities businesses within the European environment became less fun to manage and work with. But realising also that corporates were no longer getting a service that they had historically been getting. But equally, corporates had never really valued the service and had never really thought about investor meetings strategically. And I'd spent a good proportion of my professional life sitting in these company meetings and listening in these company meetings. So what I realized is that this is a massive opportunity for companies when they meet investors to utilize that time more effectively, more efficiently, and help their businesses in doing so. And that's pretty much why I set Feros up. We work with companies across not only Europe, but also South Africa. We worked across many different geographies, but France, Germany, Italy, Switzerland, all over the place, because business problems generally are universal. What we effectively do is we identify and help the business identify what the problem is, and the problem isn't always what you think the problem is, and then work around how we communicate and facilitate the business achieving what it wants to achieve with its capital structure, with its capital needs and requirements, be that through access, selecting the right advisors. For the purpose of this meeting, and because Ali said, Simon, put it into 10 simple steps, so I put it into 10 simple steps. It is, we've broken it down into the very kind of high level, simplistic questions on sort of the why, what, how, when structure. But what I would say about a company is rarely does a company think, why am I doing this? We all do it, and a lot of companies are quoted because they're quoted. They go and see fund managers because they have to. It's part of their job. We do roadshows to the US. We do roadshows everywhere, geographically speaking. And it's nice, isn't it? It's great fun. You fly to New York, you go to Boston, you go to Chicago, you go to all these great places and meet really intelligent people without ever actually thinking, why are we doing it? So why is the first question from a corporate perspective. I'd say to every management member, think about why the business exists. The business that you work with, the business you work for, business you own. Why does it exist? At its heart, what need is it servicing? Where is the bit of the business that creates the value? The most common kind of mistake I hear and see when I'm sitting in meetings or listening to companies present is they frequently spend a lot of time focusing on the history of the business and then their P&L and maybe how they hope to grow, without ever actually saying, here in the business is the bit that creates the value. This is the bit that differentiates us. And that's the bit that makes fund managers buy your shares. If they can understand that bit. The other point I would add to this is, when you are meeting investors, they are super bright, always. They're not always the most industrious. If there are any fund managers on this call, you clearly are in the industrious group, but there are a number of fund managers who are not industrious. So don't always assume they've done some work. Do always think, I'm pitching my company and what it does to a class of preschool children. If you can break it down to that level, you can identify the value part of your cultural DNA. And that's the bit that a lot of people, when the fund manager leaves a room and he's met a company, and he'll go, I just met this company, and what do they do? And he'll go, oh, and if he hits that bit, you haven't got him. He needs to be able to say, they differentiate because they do this. So the first question, and write it, you know, when we're working with companies, we often start very old school ways, and we get the boardroom table out and we get flip charts out and just get people to write them. Like, why does this business exist? What need is it servicing? Who is it servicing? How is it working? That's the first bit to think about. So we've worked out why the business achieves. Specifically, what is it you want to achieve? Not only with the business, but with the capital of the business. Because in talking to investors, what you're really doing is talking about the bottom half, or the debt and the equity, and I would encourage you to think of those pools as one pool of capital rather than separate distinct pools of capital. What are we trying to achieve with the capital in the business? Now, a lot of companies are quoted because they're quoted. You know, not every quoted company in Europe, sadly, is a client of mine, but lots of them are quoted and don't really have a great deal of requirements or needs to communicate proactively with the capital markets, because what they do is effectively they're fulfilling their corporate governance requirements. It is a corporate governance requirement and it's generally best governance practice, and governance is taking a hugely more important part of an investment process. What they do is they go and see investors because they have to. Yeah, our guy gets dragged along, carries the bags, pours the coffee, but they do it 3 times a year. You know, it's a bit of a pain. Whereas growing companies, mid-sized companies, these people need to think about it a bit more strategically about what it is they want to achieve. What you are not trying to achieve, categorically, your objective is not a higher share price. It is not to raise capital. They are both outcomes from the process that you do. Okay, so the problem with the share price focus is, so I'm a very lucky man, married a girl I went to school with. And if I solely focus on, if I bring flowers home every Friday comes home from work with a bunch of flowers every Friday, guess what? Next Friday, my wife's expecting a bunch of flowers. If I don't bring them, I'm in trouble. And I'm in trouble, I haven't done anything. So my point would be, all I focus on is the share price. All I talk about is the share price. All I think about is the share price. Fund managers are not going to buy your shares. Your share price is an outcome of the work you do. It's also very difficult to keep the focus on it, and ultimately it doesn't end well. So historically, the business is trying to grow. Most businesses are trying to grow. They're either trying to grow organically or they're trying to grow acquisitively. Organic growth will be through taking market share from competitors or being key positioned in a growth market. And how is that growth going to happen? How are we going to take market share? This is what we are trying to achieve. And one of the best ways of achieving that also is to lower the cost of capital for your business. The way you lower that cost of capital, obviously through the communications, and then getting the value of your business reflected. Also what you're trying to achieve. There are many different objective examples and lots of different reasons we get involved. So let me use one of these examples. Diversify your shareholder structure. I'm going to come into why this is important a bit later, but often we get brought in because your shareholder structure, your capital owners, your debt owners, as well as your equity owners, are a risk for your business. Concentrated risk is a bad thing. Diversified risk is a good thing. So think of your equity structure in a similar way. Lots of it, we've been brought in because of objectives will be, we've done quite a few defense projects where as a company either being shorted or being attacked by short activists, or you've got an activist on the register and how do you engage with them, or the wrong people in the equity, how do we diversify the holding? All of what I'm trying to say is, firstly, you know why you exist. B, what do you want to achieve? It's pretty straightforward strategic stuff, right? But thinking about it in your communications through your shareholders is as important as thinking about it in the communications with your business in its higher. So once we know what our objective is, you know why we're here, we know what we want to achieve. Next big question, how are we going to do it? If there are any investor relations guys or IROs on this call, you have my deepest sympathy for doing one of the world's great, most underappreciated jobs, because frequently the investor relations department, I think, is seen as or the investor relations guy, if you have one, is seen as sort of as an add-on. It's not really seen as core or central to what the business does. The communications channels around the business, be they marketing, sales, internally, when you're trying to hire people, all of it consistent. All of it consistent. When you meet international investors, if you walk out the door and they think you're a good company, the next thing they're going to do is go on websites to see what your employees think of you. Glassdoor, if you've not seen it or look at it, is a standard part of most investors' processes. So having a consistent communication channel, if all it takes is to integrate a simple exit interview with people, because you're going to have good leavers and bad leavers. Everybody is going to do that. Bad leavers are always going to moan because they're not happy. The one guy that goes on and moans on green door, if you can say to your good leavers, hey, you've enjoyed your time working here, we've had a good relationship with you, all the best for your future, wouldn't mind going on Glassdoor and dropping us a couple of good comments, would you? That actually helps. Have a consistent communication method, internally, externally, marketing, sales, investors, all of them. Always assume they all know each other and they all speak. Definitely assume all fund managers know each other and they all speak, because they do. So we're going to think about how we're going to achieve our objectives. One of the most consistent things is, one of the frequent things I find is that how a business is managed internally and the processes by which they allocate capital and make decisions are inconsistent with the way in which they communicate. It sounds pretty dumb, doesn't it? It sounds pretty straightforward, but you'd be surprised. So if your key internal metric on allocating capital and making a decision is I'm going to use cash flow return on equity because, sad as it is to admit it, it's my personal favorite. But we use cash flow return internally, and externally people aren't using that. Then they're making a decision to allocate capital to you in an inconsistent way with which you are allocating capital internally. That way, happiness does not lie. So if you tell them which key metrics you are using internally, don't disclose sensitive information like what those margins are or the customers might benefit if they know, but help them with their process. And if they need to be making the investment decision the same way around you, which you make decisions internally. So yeah, in short, as I said, help them with their process, because in doing so, you're going to achieve, you wish to, let's walk through an example. as an entire. We want to grow by taking market share. To take market share, we need to be a bit more price competitive. To be more price competitive, we need to buy a machine. To buy a machine, we need money. Great. So what we need to explain to the people who are giving us that money is, we think the payback period on this machine is X. We think it impacts our operating margins Y, which allows us to do this and grow our market share. That's the process you're doing internally. That's the process you'd be explaining, which surprisingly, you don't always see that. And the separate, moving on one more, so moving on the sort of next part of the journey is step 5, as I've made it step 5. Who, right? Who are our right partners for the journey? And I'm using the partners in the complete value chain sense of the word. Not only who are our future shareholders or current shareholders, and are they the right ones? First step, who are our advisors? Who are our advisors? Clearly, at this point, big plug, KASB, always a good advisor. Now, moving on from that bit, it is important that your advisors are culturally aligned with who you are. You are paying them for their advice, not only them to tell you nice things, but their advice. So you want people in the room who aren't trying to sell you anything, but whose integrity you're not questioning, but who implicitly you trust. That's the first part of the process. And one of the big things we do, and I do regularly with the companies we engage with, in the UK, we've got this crazy system called corporate brokers, which if anyone really wants to learn about it, I'm happy to explain it. But frequently there's a misalignment, and these are people who represent you in the marketplace. Frequently there's a misalignment between who these people are and who the company are. One of the big things we do is work around identifying the right partners to work with. And it's not about price. It's never about price. If saving yourself, you know, I use UK currencies, but if you're saving yourself 10 or 20,000 pounds a year on an advisor is the process by which you're making the decision, it's the wrong decision. So who's going to be in the room with you first? And then secondly, who are the right holders of your equity? Do target people. I'm going to use some very specific examples. I work with a fantastic UK tech company called IQE. They manufacture compound semiconductor wafers, which anyone who has an Apple iPhone, which I'm assuming is most people on this call, the Face ID thing, there's a little laser that comes out and hits your face. They do the wafer that does that. Very clever stuff. But anyway, biggest issue we have with them, we have 2 shareholders on their register. It's all public information, so you can access it. T. Rowe Price is one of them. Oppenheimer, now Invesco, is the other one. Between them, they owned 30% of the equity, a little bit more. Fidelity, or a house like Fidelity, wanted to buy a big stake in them. That's the last thing they want and they need. As flattering as it is to have a blue prestige mark on your shareholder register, if another big investor comes in and buys a stock, this stock becomes uninvestable. So when fund managers look at stock, they'll often say liquidity or free float. They don't mean that. They often say what they don't mean, but they definitely don't mean that. What they mean is they're limited to how much shares they can buy by what the trading volumes are. Most investors, for reasons that are completely irrational and based on fundamentally flawed logic, restrict themselves to 3 days trading volume. Their belief, their risk manager sits there and says, yeah, but if things get really, really bad, we can exit the position in 3 days. If things get really, really bad, you cannot exit the position in 3 days, but that's the rules. So they generally will look at a stock, look at the free float, look at the trading volumes, take 3 times that, that's my position. So we don't want lots of big shareholders. What we want is a diversified pool of shareholders. There was a case in the UK, I'm assuming you probably do know it, maybe you don't. There was a fund manager called Neil Woodford. Neil Woodford was a star fund manager, right? He was a brand. He left Invesco and set up on his own. He invested in lots of small illiquid stocks that didn't do very well. And along came a county council, one of our regional authorities, which was the source of his capital, and said, we want our money back. He couldn't sell the shares, couldn't give the money back. So he said, I'm really sorry, I can't give you the money back. They immediately realized they had an equity risk and took £300 million out of somebody else's fund. And as soon as they did that, all the other regional authorities, because this got lots of news coverage, took money out as well. So if the principal source of the fund for the fund managers was local authority money, you had to sell all your equities. If you were a company and you were owned by people whose principal source of equity was these local authority money, your share price went down a lot. The point I'm making here is the sources of capital for your shareholders need to be different so that you're not solely exposed to one risk. If you have, for instance, the majority of your shareholders being your domestic funds, who I'm sure are great funds and brilliant people, but there is an incident for which we don't know about yet, which causes liquidity to come out of those funds, your share prices are going down. If you have a diversified shareholder base geographically, and by that a diversified shareholder base, so maybe it's not only retail, but maybe you've got some high net worth sort of assets in there as well, or maybe you've got some pension funds in there, some corporate pension funds, you are mitigating that risk to which you're exposed. So in the same way you think about the risks that hit your businesses from operationally, think about the risks to the business if the share price suddenly goes down 50% because of an incident that's out of your control. So back to the who are the right people. Focus on them, think of them, do target specific investors and investor targeting. And there are lots of firms that do this. And I think a lot of them sell a con, because what they will do is they'll look at you, look at what sector you're in as a company, and they'll say, right, you're a cement company. Here are 3 funds that own other cement companies. We should go and talk to them. Wrong. These 3 funds have already looked at cement companies and they've decided not to buy your one. So who else is maybe underweight the cement sector? That's a better target. Who normally has a position in their fund of 1.5% of their assets and has got a position in your stock of 0.25%. They're either a buyer or a seller, more likely a buyer. Let's go and focus on them. So do target, but think strategically about how you target. We do a lot of work around targeting, a lot of communication work around targeting. Brilliant. They're the first 5 steps. We're going to do the 5 again, but we're going to do it from the investor-based format. So, our investor, why is he in the room? Right. The psychology of the investment decision is not focused around why should I buy your shares. The focus in the investment room is why should I not buy your shares? The reason for that is the average asset manager, roughly speaking, and I'm being very generalist here, so please bear with me, but they probably have 100 holdings in their fund. They maybe meet, the average fund manager will meet 400 companies a year. So let's give him credit and say he's meeting the 100 that he owns. Let's take them, put them to one side, he owns them. So of the 300 companies he's meeting who he doesn't own, a busy fund manager, refer you back to my previous comments, will maybe make 20 big decisions a year. That's in a busy year. So of those 300 companies he's meeting, for 280 of them, it's a hard no. For 20 of them, it's a yes. So his process going into that meeting is, why should I not buy these shares? Nobody will get fired if they don't buy your shares. If I have just bought Wirecard 3 weeks ago, I suspect my boss is calling me in for a bit of a chat right now. So identify what the no's are in your equity story. Don't only focus on the yeses. So let me think of a no. Free float or liquidity is probably the main one. Would love to buy your shares, but I can't because there's no shares traded. Great, thanks for taking the time to meet me. I would even say, if you identify the no's, own them presentationally. Don't wait to be asked. If you are proactively owning the points of which investors have concern, you look very much like a management team in complete control. One that can be trusted, and I'm happy to buy your equities. Actually, I'm going to change that. So one of the companies we're working with at the moment, the CEO is 65. A young man now, by my standards, I find. But anyway, undoubtedly, the fund managers are thinking, great business. This guy's been fantastic for 20 years. Who's coming next? He needs to start talking about succession now, even if it's 3, 4, and 5 years away. Because it's the biggest concern people have. In key man risk, we'll come back to sort of the who should be presenting your company towards the end, but not having one person present all the time, so they don't only think of the company as one person. So if an accident happens to that one person, or that one person leaves. I very, very tragically lost a very close friend and client to 2 years ago this April, who was killed whilst on holiday. He was the CFO of a company. That immediately impacts the share price. You can't plan for tragedies like that, very sadly, but you can plan for things like retirement. And if you own the concerns the investors have, if you identify the no's and own them, you are knocking down the pillars that get them to become a shareholder. And on that note, if you are a company, a private company, 70% owned by the founding family, let's say, I think the line of least resistance will lead you pretty much to only talk to the incumbent shareholders. Not great. Back to the shareholder risk. These guys are possibly all interviewing elsewhere for jobs anyway. If they leave their current job, then I'm the new fund manager comes in. I've got a very brief window by which I'm going to stamp my authority on this particular fund, and I'm going to sell the old guy's stuff. So always be aware that you have a risk in case shareholders leave. And the broader message is don't only focus on your incumbent shareholders. Even better, if you can find somebody who is actively doesn't like you, that's too hard a word, but if you've always engaged with the analysts who have a sell on you, if an analyst writes a sell note. I've just this morning been engaging with a client and a company, and the asset manager is short the stock, right? So he clearly is very negative. But I know that guy who's short definitely has to buy back at some point. So let's engage with him. Let's not give him a platform. Let's not get into a group scenario, but let's engage with it. So don't only focus on the holders. In fact, put as much time into focusing on non-holders, I would say. So firstly, we're starting to understand, sorry, I wandered off there a bit, but why the investors are in it. Secondly, what is it they need to know to get them to buy or make an investment decision? What we want them to do is make an investment decision. Hopefully it's I'm going to buy some shares, but if it's not, it doesn't really matter. Super polite to the fund managers out there, but there are a lot of them. So more importantly, that people do, we care that people do, but not who does. Taking a big step, there are not, as I frequently hear in the press, generally speaking, there are fraudulent companies, they're bad, but generally speaking, there are not good companies and bad companies. There are not good equities and bad equity. There is expensive equity and there is cheap equity. That's what we're focusing on. Companies' equities are priced relative to the risk of that business and how that risk is perceived. If you wish to get an improved rating, get the risks associated with your equities better understood. What investors need to know are the risks associated to being a shareholder in your business. There is some technical stuff that we've spoken about already, like the free float will be limited, but if that's going to change. The other thing I'd say, coming back to my very lovely wife analogy, who thankfully is out of earshot, he says, looking over his shoulder a little nervously, investors hate surprises, even good ones. And I know there's this temptation to overpromise, so underpromise and overdeliver. Don't overpromise and underdeliver, that's bad. But to overpromise, to underpromise and overdeliver. Don't do that. Seriously, don't do it. Because if you tell everyone you're going to make 100 and this year you make 110, next year you tell everyone it's 110, it's 120. Year 3, you tell me it's 130. If it comes in at 130, that's a disappointing number. So your PE ratio, your EBITDA multiple, or whichever metric you're going to get used to value your equity, will increase over time. The risk associated, if the risks associated with your business are better understood, if you're forecasting, if you're in a lucky business where you can forecast your numbers down to the last penny, be accurate in your forecasting. You will get rewarded. You will get a premium value in a longer term. Ultimately, continually beating your numbers sort of says, I don't really know. It's okay to have no visibility. There are plenty of companies out there who've got no visibility, and they go out on the front foot and say, one of the big no's, no visibility. Page 1 of the presentation, guys, we've got no visibility. But these are the macro trends that affect our business. That semiconductor company I spoke about earlier, IQE, Very, very limited visibilities. But if you want a 5G network, you need compound semiconductors. These guys make them. Macro trend, really good. Can I tell you what next quarter's earnings are going to be? No. Why? Because the point of what investors want to know is they want to know the information surrounding the key risks with your business, because it will get them to better understand your equity. The final thing I would say, please do this. If you took one thing away from listening to me rabbit on for hours, I would say very few companies do this thing. And I always encourage people with this. Have some questions. Inadvertently, get a fantastic education in corporate strategy. They meet the best bit of, back to my comments, best thing about being a fund manager, you get to meet guys who are super successful in the businesses they operate. You get to ask them questions, you get educated, and you get to satisfy your own intellectual curiosity. So instinctively, they've got a very good strategic education. And if you say to them, what do you think about that? What do you think about this? As an aside, a good tool with which we is to discuss the strategic options of your business in multiple choice format. So if you are genuinely thinking about making an acquisition, you might say in a room to an investor, we're looking at growing, key markets doing pretty well, strategic options are up and are, consolidation in the marketplace is an option, here are some targets we could think about. Equally, we could look at new geographic markets, always give them in a broad spectrum rather than saying we could buy that company, because that's turning into an area where you probably shouldn't go. Then ask them their opinion. Asking them their opinion is a phenomenally salesy thing to do, but it really works because we really like to be asked our opinions. So what do you think I should do? Now, if you give people 5 options, statistically, 20% of the audience are going to give you the option you're going to do anyway. When you do that option, I guarantee they're going home that night and over dinner, they're going to say, I met this company. I told them they should buy this company and they've just done it. That's on me. There's a shareholder for a very long time. So come back to thinking about how you utilize your time with them once you've worked out what it is they need to know. Coming on to my final couple of slides, I think. Yeah, final one from my number 10. Who should present the company and who should it be meeting investors? The vast number of companies that I work with at the start will often have the whole management team go on the road together. Now, when the whole management team go on the road together, you tend to have one person, the CEO, the boss, who does most of the speaking, leaving the fund manager to leave the room and say to his colleague, why was the other guy even there? If you're doing a results presentation, a numbers presentation, you've just put out your half years, you've just put out your full years. We want investors to talk about the numbers. The best person to talk about the numbers is the CFO. It stops the strategic questions. Let's put him on the road. Also, our scarcest resource is time. So thank you for taking this time to spend it with me today. But your scarcest resource is time. If we sit down and we're going to say, we need to allocate 20 days a year, 20 days of man-person time to meeting investors. So that's either 10 days of the CEO and CFO together, or 20 days if each one of them does it separately. Also, to mitigate the risk of key associated the business with one person, and also to give your internal management opportunities to grow and room to grow, utilize the time with investors to get them to meet other people in the business. Capital markets days, definitely do one, they're a good thing, but use it to show the internal management are performing well, give them a chance to show off to the investors, and equally to give the investors time to do some diligence so that should the unforeseen horrible thing happen, they know there is strength of depth in this business and it's not something that concerns them. So one person does not become the company. There's a low-cost airline in Europe called Ryanair. People you say to Ryanair, to most investors in the UK, they're going to say Michael O'Leary, who's the CEO. Ask them to name anyone else in that business, they can't. He leaves today, their share prices go down a lot. So think about those issues, which is certainly something we think about quite a lot. Use capital markets days. Do travel as a team sometimes, but also travel separately and independently if you're focusing on a specific message. So It feels like I've been talking for ages. So conclusion-wise, treat all your investors equally. Identify what your no's are, integrate the capital of your business into your corporate strategy and communications, and then work out what the kind of philosophical questions of why you want to do this and what it is you want to achieve. That will help you achieve it, I think, I hope. As I've said already, I'll give you one example at the moment that we're working with. So we're working with a fantastic business in the UK called CareTech. CareTech run homes for physically or mentally disabled children and young adults. CareTech was originally set up by two. The reason I'm bringing it up is the two management team are Pakistani brothers, Farid and Harouk, and they had a property business. One of their directors' children had a certain specific needs and they couldn't find a home to facilitate these needs, so they set one up. They set that one up, that became the business, that's now the business. The problem they had two very small UK advisors who had pitched the stock as a healthcare stock. This company is not a healthcare company. If you look at the margins, and if the analysts and training analysts or anyone who was an analyst, one thing I would say, definitely do this bit. If I gave you the P&L of this company and I gave you the balance sheet of the company, took the name off the top, took any words on the top and said, what sector is this company in? No one is coming back and saying healthcare. There is no huge R&D budget here, right? There's no pipeline of development. You won't see words like clinical phase 3s. So when they were meeting investors who all had PhDs, by the way, in molecular biology, meeting a company that is a service company, I'm realizing Ali's telling me time very subtly. Okay, wind up. Wasn't what they did. So actually getting them to have the right owners of the business who looked at it properly has facilitated their shareholding, so the right holders, but also an appreciation of the share price. I'll shut up now and go over to questions or not, if there are any. Thank you again for listening to me. I hope it wasn't too dull.
It was a pleasure. Thank you. Thank you for all those insights and advice, and especially the tips which you gave. It was very valuable for me listening to that as a company operator. And I think the key points, some of which stood out for me, was one, keep it simple. B, diversify your shareholder base. C, when you're communicating, keep a consistent message. It's not just important that one guy is saying one message, but the whole organization should have that message. You gave the example of Glassdoor, which is very relevant. As an analyst, I always used to look at Glassdoor, and we see that issue in Pakistan as well. In some of the companies which have seen that the IR will be telling one message, but that might not be consistent across the whole organization. So always be aware that investors will be talking to other people within your organization as well, and not just to the IR person. The third thing which you mentioned, which I thought again was very relevant, and I had an anecdote for that, which is that when you go to talk to your investors, if you're going with a team, then let other people talk as well. I recently, there was an example, I was talking to a UK fund manager, and he said he met a company in Pakistan, and there was a board meeting, and there was whole management over there, but only the chairman of the company, who was the main sponsor, he did all the talks on all the topics. And they thought that was a big red flag on corporate governance, that if the chairman is doing all the talking and the rest of them are not. And also, thank you for bringing that up, that key man risk also exposes the business that, what if the fund manager leaves and they have to sell it just because of this? Or what if that person who's responsible for investor relation interaction, if he leaves the company, then that just impact your share price, and you're just because, investors associate your business because of him. And it will be even worse if he turns up at a competitor, because then your shareholders can just move to that company. So Simon, thank you for all those insights. We are now open for Q&A. The format for questions, we have 12 minutes for more questions. The format for questions is that please type it on chat and I will raise it to Simon. Simon, I also thought that it was another important point which you mentioned, was that it's very imperative for companies to talk not just to their existing shareholders, but also to new shareholders. I see that issue quite commonly with companies in Pakistan, that they will spend a lot of time talking to their large shareholders, especially the large foreign shareholders. But the risk which you mentioned is very relevant, that that fund might have to sell your stock just because of some exogenous factor. The fund manager might leave, or their LPs might pull money. And we've seen it many times that those share prices then of those companies which have concentrated shareholding tend to go down if they have one shareholder who's selling. We saw that in oil and gas sector where a fund manager changed and the fund had to sell all of the shareholding, and that stock underperformed for a period of 18. So we are open for questions. Please write your questions, and in the meanwhile, I'll throw in the first question. Simon, you deal with a lot of family-owned businesses, especially in your career at Berenberg. A lot of Mittelstand companies in Germany, where the founders will have 6% shareholding. Can you give us some examples of companies where they improved the liquidity and that helped the share price go up, and that helped the company create value for the owners?
Yeah, frequently, 40% of something can be worth more than 70% of something. I think the common myth is that in order to control my company, I have to own 51% of the equity. It's not true. By having a diversified shareholder base, actually, if you really want to retain a blocking stake and have control of the business, 25% is the kind of level you should be thinking about going to. Also, from an inheritance or succession basis, frequently you'll find that family members are likely to be bringing in professional management, either to support or in fact to take over a company in post the family that's created the business leaving it. And one of the things that we often worked with and spoke to was that obviously changes the culture of a business. And in changing the culture of that particular business, and it doesn't necessarily change the cultural DNA of the company, but it does mean that the management are now working for the shareholders in the broadest sense of the word. And as a family, you don't really want your single biggest exposure to be in one asset. You want to diversify that asset base. So what I definitely have seen across a number of companies is in selling the equity more gradually and gently across a period of time, and by that I'm talking 2 to 5 years, the stake they were left with at the end was worth more, or at least as much, as the stake they had in the beginning. So you also avoided some horrific. One of the cases I worked on was a German company called Khwaja, and the CEO, again, I'm stuck on tragedy today, was involved in a horrible car accident. He was a dominant shareholder at 35, nearly 40% of the equity. Germany has this crazy system whereby you have to pay your inheritance tax in a very short space of time post any death, and they had an incredibly short period of time to sell his equity, and the stock price absolutely collapsed. So generally speaking, like we're back to earlier, diversify the risk of the business. Absolutely, being cultural part of the family business is important, but to control the business, 25%.
No, thank you, Simon. And you also mentioned earlier that a very important point, that free float in terms of the trading volume is very important, and often it's a prerequisite for investors to invest in because the risk managers dictate that. And I think the point which you said, that from an investor presentation perspective, focus on the no's, focus on the risks. So I often see companies in Pakistan, they will talk a lot about what they do, but they will not talk about the equity story. What are the risks? And I think you pointed out, and this is a counterintuitive prima facie, but it makes a lot of sense, that in their meeting, you focus on what brings the risk of your companies down and address those issues. There's a question from Umar Naeem, and he's saying, what should you do when an investor doubts the authenticity of the audited financials? And he's saying this is an issue in Pakistan, but I'll broaden it out. Of course, it's not just an issue for Pakistan. We recently had an example in Germany, but there are always doubts in many examples in the UK as well. So what should a company do if an investor has a doubt about the financial statement?
Well, firstly, always doubt financial statements. So I'm speaking as a qualified chartered accountant, largely because there are a set of accounting rules that you have to interpret in order to produce them. My answer to that question is go to the thing that can't lie, and the thing that can't lie is cash, right? So go to how the cash moves within your business. In fact, do that anyway. And look at the cash flow cycles in the business and allow them to reconcile back where this business makes cash to the cash within the business. The one balance, speaking as an ex-auditor, which was very dull, The one single balance, which is the easiest to audit, assuming that your client's not lying to you, and most people in this world are not liars, is the cash balance. Show me your bank statement. Says you've got £1 million in the bank. Oh, look, tick. So go to cash is the answer.
Absolutely. Thank you for that. And thank you for also pointing out that this is not a problem just for Pakistan. But the two rules, as you said, one is cash, and B is, somebody also told me to look at the amount of cash paid as tax, the cash tax.
Yes.
Because you don't typically lie with the government. There's a very good question. How can shareholders evaluate the performance of directors of a company? And what are the best practices in evaluating the performance of director? And I know you work closely with boards, so I would love to get your views on that.
And I do sit on the board of a couple of companies. So how do you best evaluate the performance of directors of the business? Directors' jobs principally is stewardship. And it will be, one of the things would be, certainly one of the things we look at the staff turnover ratio. Look at the staff turnover ratio relative to the other companies in that sector. Because some companies have super high turnover anyway. CareTech's got, a high turnover because of its relatively low paid employment. The 20% turnover ratio is good. So you want to know if a business is a happy business and being stewarded well? Short answer, look at staff turnover ratio.
Thank you. There's another question. What is the assessment metrics for relevance of information that is being communicated, both quantitative and qualitative, to ensure that there is no information overload? And I think Simon would add on to that. I will add some on that. That what are companies in Pakistan? They all report their financial numbers, but what about KPIs? Some other key performance indicators.
Yeah, I get it. So. Start point, report and accounts. Report and accounts is the thing where you have to disclose, right? That's where you're getting most disclosure. I'm always dismayed as to how few fund managers read reports and accounts. It's the only thing you should read. It's the only document that you can't manipulate to tell your story. Your investor presentation should then be based on that. The point to information overload is absolutely spot on, because it's very easy to overload fund managers with information. And if they leave the room confused, they're definitely not looking at buying the equity. So I guess it's back to simplifying the structure. If you are companies, simplistically, high level, you either are cheaper or you're better. You can't be both. I know lots of people say they will. You can't be both. You're either cheaper or you're better. If you're better, you've got better margins than your competitors because your products are better. So simplistically with that, what we're going to do is we're going to highlight our margins relative to our competitive margins. That shows our products are better. If we're cheaper, we're going to have higher volumes and higher profits. They're the metrics we're going to use. So think simplistically of what it is the business does to generate the performance, provide the information to support that analysis. The KPIs you use internally, the hard KPIs, the qualitative ones, should be also the same ones you communicate. Right? If you're looking for a 10% hurdle rate return on capital prior to making an adjustment, that's the one you should be communicating. And the soft ones, back to the things like staff turnover ratios, which are a good way of annotating, is this a happy company or not?
Thank you, Simon. And I think going back to the first point which you mentioned, which is to keep it simple and assume that fund managers, they're listening to a lot of things and they need to take it out in terms of what do you do and what differentiates you.
I mean, they're clever guys, right? So they will get things very quickly.
There's a very interesting question, and I'm just shortening it, that during the crisis time, like the current pandemic, how has that impacted the psychology of investors? And what would be the focus of communicating in times such as current times?
Okay, so in times such as this, what I would say is investors are never investing for today. They're looking at next year's numbers and 3 years' times numbers. I would say right now, fund managers that I speak to every day on a daily basis have already moved through the COVID crisis. They have already done this. The discussion is more on the shape of the economic recovery and the amount of governmental spending that's going to stimulate it post the other side of this. The way in which the best companies dealt with it, I'm going to refer back to my personal situation. You can't communicate too much. So in times when you have great uncertainty and you cannot forecast your numbers anymore, and most companies withdrew their annual forecast, the thing you can do is immediately get out there, talk to your investors and say, and please, the first thing you should say in the current crisis is our first thoughts and our first concerns are our staff, their health and their well-being. So this is what we're doing to protect them. The second thought then will be, this is what we don't know, and this is what we do know. It's like in an interview, saying I don't know is a perfectly acceptable answer. So when you don't have any ability to forecast, that's what you say. Right now, we have zero ability to forecast. And what you're getting there is integrity points and honesty points, which are very, very important. So what you can do when you get time, but what I can do to you is, instead of talking to you twice a year or every quarter, what the best companies have done is they are now talking to investors every month, and some of them more formally or informally to investors and non-holders every week. So rather than, I would say, how the situation has changed in the past 3 weeks, or past sort of 3 or 4 months, sorry, it's all merged into one, has been because fund managers are at home, it's easier for them to sit down and talk to the companies they're invested in or companies they're interested in. So whilst we have lost a formalized structure of speaking on a quarterly basis and going on a roadshow, we are communicating 2 or 3 times a week. There's a call. So you're much more pragmatic and responsive. But in all communications, always just be honest, right? Sometimes you're going to have to deliver bad news. You're going to have to deliver profit warnings. That's fine. It's not great and no one likes it, but you have to deliver it. Get out there and be in control of it.
So proactive. No, thank you for that, Simon. I know we have reached the full time, but I would squeeze in 2 more questions just because I think they're very interesting. And there are a lot more questions. So I apologize for people whose question I've missed. The first is that, Simon, you have been a fund manager, and so you have invested in companies and looked from that side, and now you advise the company. So you're on the other side of the table. As a fund manager, when you were looking at companies, what were the red flags you saw or you would spot when you were hearing a company tell the story? And the second question, I'll just add it, is on ESG. And it's a topic close to me, and I know you also advise companies on their ESG strategy. So would love to hear from you in terms of how can company communicate that better and why is that important?
Okay, so first I'll do the red flags one. The very simplistic red flag is, if I can't go home and explain to a 3-year-old what a company does, there's a flag. Because I know that all businesses, there's some incredible technology and some really complicated stuff that you need a PhD to understand. That's great. But simplistically, you can break it down to me. The second thing I would always do is follow the cash cycle, how cash flows through a business. And if you can't follow that, then there is something going on that isn't quite right, and avoid it. Now, it could be, it's me, right? That it's just too complicated for me. So, and I know I've said it and I've banged on about it quite a lot, but equally, average tenure of staff members, average tenure of directors, how quickly are people turning over, or are they not turning over at all, which is also as equally a red flag. So coming to ESG. For ESG, I would do small e, small s, capital bold, double underlined, font 50, G, because that's the way investors look at it. There are 2 things to do with ESG. From an investor perspective, it's about currently predominantly not form filling, but bureaucracy. For instance, a lot of it is about disclosing policies and making them aware and publicly available to investors that I'm sure already exist within the business. But for instance, adopting the UN statement on not employing slave labor. Right? I'm sure that all companies adopt it. Do all companies have it on the website? If it's not on the website, then you're not ticking the right box for a governance investor. Average tenure of directors, non-family holders should be 9 years maximum. Are directors turning over? That's one of the other questions. I think personally that one's dumb, because you've got someone who really knows a lot about the business, but don't hate the player, hate the game. The focus is more on governance than on environmental sustainable. It's also relevant. I would say international investors, 3/4 of them now at least, have it as part of their process, have it as the start of their process. The other thing I would say is the AGM votes, the only issues they'll vote on governance, and frequently for the international big funds, it's not the fund manager you meet that has that vote. They have a separate person internally, and therefore, once you become a more index company and a bigger established company, you should be doing a separate governance roadshow. The best way to do that, and the way in which we do it frequently, is to take the chairman of the company, which allows the board to get unfiltered feedback from the fund managers directly, because they build a relationship with the CEO, and they can say, listen, it would be really helpful if he had his hair cut. I'm just talking because I haven't had to have my hair cut for ages. So, but they're not going to say that to you because it's a bit rude, but they will say it to the chairman. So we'll often get the chairman around to do meetings with just him in the room and the asset manager, and we'll get the governance people in the room as well. So on the ESG, focus on the investor focus is on the governance side of that particular equation currently.
Thank you, Simon. This is very relevant information and something which is new to me as well. So thank you for bringing that up, that you highlighted that in most funds, it's a requirement for ESG, and the G part is more important. And in most funds, it's not the fund manager, but they will have somebody else who's just evaluating the company on those matrices. So it's important for companies, and there are a few large companies from Pakistan who are listening to this. It's important for them to reach out to that person who's evaluating you on G, because it's a requirement. So even if the fund manager likes you and he has been holding you, that person who's looking at G, if he thinks that you do not meet the criteria, he will force the fund manager to sell your stock. So it's important for you to start communication with that. And Simon gave a very good advice that the chairman might be a better person to communicate with that, because the fund manager who's looking at governance might be more open, because then they can share those things which they might not be willing to share. And often the companies also become very defensive when they hear criticism. So it might be easier for the chairman to take that kind of feedback.
And brokers in their feedback, which is really valuable stuff, but also we're sensitive, and historically speaking as well, to the corporate criticism. So if a fund manager said to me, I hate that guy, like I really hate him, I hate who he is and everything he stands for, the feedback is going to say, potentially there's some conflict issues here. What I'm not going to say is for sensitivity reasons. So always be conscious that feedback you're getting is never as good as getting the feedback directly.
Thank you, Simon. This was extremely insightful. Thank you for your time. The recording of this video will be available on KASB's website, ksb.com and ksb.blog. I think.
And you have the presentation, Ali, if anyone wants it.
Yes, so Simon, thank you for that. I will also put Simon's presentation online. And I think IR is really important role for us. Effective communication is really important. And it's one area where, by focusing on which Pakistani companies, some of which who are listening to this, can improve shareholder value and make themselves better companies. So Simon, thank you again for your time today.
It's a complete pleasure.
Thank you. Take care.
Bye-bye. Thanks, guys. Bye-bye.